Have you ever noticed how the wealthiest people seem to get even richer during economic disasters? 2008 financial crisis, billionaires buying up real estate for pennies on the dollar. 2020 pandemic, the rich accumulating massive wealth while everyone else struggled to pay rent. It almost feels like the game is rigged, right? But here's what nobody tells you. It's not rigged in the way you think. The wealthy aren't just lucky. They're not insider trading their way to success. They understand something about recessions that most people completely miss. And here's the crazy part. You can use the exact same strategy. My name is Ivan, and I spend way too much time thinking about money, compound interest, and why most people never seem to escape the paycheck to paycheck cycle. If you are someone who actually wants to understand how wealth building really works instead of just hoping for the best, make sure to hit that subscribe button and give this video a thumbs up if it ends up being helpful. Let's start with what happens when most people hear the word recession. Panic, fear, the instinct to protect what you have. Hunker down, stop spending, definitely stop investing, wait for things to go back to normal. It makes perfect sense, right? When times are tough, you save every penny. You avoid risk. You try to just survive until the storm passes. This is what 99% of people do, and it's exactly why they stay broke. Here's what's really happening. When you think about a recession, you're imagining loss. Lost jobs, lost savings, lost security. But wealthy people see something completely different. They see a sale. Think about it this way. Imagine your favorite store having a massive going out of business sale. Everything is 70% off. Designer clothes, electronics, furniture, everything you've wanted is suddenly affordable. Would you say things are bad at that store, so I better not shop there? Of course not. You'd be there at opening time with your credit card ready. But when the entire economy goes on sale, when stocks drop, when real estate crashes, when incredible businesses are selling for half price, what do most people do? They run away screaming. The wealthy run toward it with open wallets. This isn't just about having money to invest. Plenty of rich people lost fortunes in 2008 because they panicked just like everyone else. This is about a completely different mental framework. It's about seeing opportunity where others see disaster and understanding that real wealth isn't built when times are good. It's built when times are terrible. First principle, the crisis discount. During normal economic times, everything costs what it's actually worth, maybe even more. Real estate gets bid up. Stocks trade at high valuations. Businesses sell for premium prices. Everyone's competing for the same assets. Prices go up. But during a recession, something fascinating happens. Fear becomes more powerful than logic. People start selling things they don't want to sell because they need cash now, because they're panicking, because everyone around them is panicking. And here's the key. They sell for way less than these things are actually worth. A house that was worth $500,000 gets sold for $300,000. Not because the house got worse, but because the seller is desperate and buyers are scared. A solid company with great products sees its stock drop 60%. Not because the company stopped being valuable, but because investors are terrified. This is the crisis discount, and it's the single biggest wealth transfer mechanism in modern capitalism. Think about Amazon stock in 2001. It dropped from over $100 to $6 per share. $6. The company was still Amazon, still selling books and expanding, still had the same business model that would eventually dominate the world. But fear was in control. People were selling at any price. The investors who bought Amazon at $6, they understood the crisis discount. You don't need to be rich to take advantage of this. Okay, you just need to understand that when everyone is selling in panic, the smart money is buying on sale. The psychology behind this is actually pretty simple. Humans are loss averse. We feel the pain of losing money about twice as strongly as we feel the pleasure of gaining it. So when things start going badly, our brains scream at us to stop the bleeding. Sell, get out, protect what's left. The wealthy have trained themselves to ignore this instinct, or better yet, to use other people's panic as a shopping list. Second principle, the liquidity advantage. Liquidity just means having cash available, not tied up in stuff. Actual money you can spend right now. During good times, most people don't keep much cash around. Why would you? Savings accounts pay almost nothing. The stock market is going up. Real estate is appreciating. Cash feels like it's losing value just sitting there, so people invest everything. They're fully invested, maximum exposure to the market. This seems smart when things are going well, you're capturing all the gains, but here's what happens during a recession. Everything drops. Your investments are suddenly worth half what they were. You need cash for emergencies. Maybe you lost your job. Maybe unexpected expenses hit. So you're forced to sell your investments at the worst possible time, at the bottom when prices are lowest. You lock in your losses, you miss the recovery, and you have no cash left to buy anything on sale. Meanwhile, the wealthy have been holding cash, waiting. Yes, that cash wasn't growing during the good times, but they weren't trying to squeeze every last percent of gains. They were staying liquid, keeping their powder dry. When the recession hits and everything goes on sale, they have cash ready. They're not forced sellers, they're eager buyers. Let me give you a concrete example. Let's say you have $50,000 in 2007. You invest all of it in index funds because the market's been great. 2008 hits. Your $50,000 is now $25,000. You panic. You need money for expenses. You sell at $25,000 and lock in that loss. Now compare that to someone who kept $20,000 in cash and invested $30,000. When 2008 hits, their $30,000 drops to $15,000. It hurts, but they don't need to sell because they have that $20,000 cushion. Better yet, they can use some of that cash to buy more investments at crashed prices. Fast forward to 2010. The market has recovered. Poor Peter is still trying to rebuild from $25,000. Rich Richard's investments have bounced back and the extra shares he bought at the bottom have doubled. Same starting amount, completely different outcome. The liquidity advantage isn't just about having money, it's about having options when everyone else is desperate. Here's the uncomfortable truth. The financial system is designed to transfer wealth from people who need cash now to people who can afford to wait. Recessions are just when this transfer happens fastest. Third principle, income insurance. Most people's wealth is their job. They trade time for money, one income stream. When that stream dries up, panic sets in immediately, but wealthy people structure their finances completely differently. They have multiple income streams: rental properties, dividend-paying stocks, business ownership, royalties, investments in various companies. When a recession hits and one income stream slows down, they have others that keep flowing. Here's where things get interesting. Not only do multiple income streams provide security, but during a recession, you can build these streams for cheap. Real estate becomes affordable. Businesses are for sale at discounts. Dividend-paying stocks are on clearance. So while the wealthy might see one or two of their income streams decrease, they're simultaneously buying 5 more at recession prices. Let me tell you about 2 software engineers both making $100,000 to $20,000 per year. Poor Peter has only his salary. That's it. His entire financial life depends on his company not laying him off. 2020 pandemic hits. His company does layoffs. Peter is terrified. He has maybe 3 months of expenses saved, no other income. His investments are down 40%, so he can't sell those. He ends up taking the first job he can find at lower pay. He's just trying to survive. Compare that to rich Rachel. She also makes $120,000, but spent the previous 5 years buying a small rental property and investing in dividend stocks. Her rental brings in $1,000 per month after expenses. Her dividends are another $800 monthly. It's not enough to live on, but it's something. When she gets laid off, she's not immediately desperate. She has $1,800 per month in passive income plus savings. She can be selective about her next job. She can negotiate better. She's not accepting the first offer out of fear. Even better, she sees real estate prices dropping. She uses this time to buy another rental property at a 30% discount. 2 years later, Peter is still recovering financially. Rachel has 2 rental properties and actually came out of the recession wealthier than she went in. The difference wasn't their salaries, it was their structure. Income insurance means you can be patient when everyone else is desperate. And patience during a crisis is worth more than almost anything else. Fourth principle, the knowledge gap. Most people don't understand how money actually works. They know how to earn it at a job, maybe how to save it, but they don't understand assets, liabilities, cash flow, valuations, or market cycles. This isn't their fault. Nobody teaches this stuff in school. Most parents don't know it either. So people bumble through life making financial decisions based on feelings and what they hear from friends. During good economic times, this ignorance doesn't hurt too much. The rising tide lifts all boats. Even bad investments make money when everything is going up. But during a recession, the knowledge gap becomes deadly. People don't know what's actually valuable versus what's just expensive. They can't tell the difference between a temporary dip and a fundamental problem. They don't understand how to evaluate opportunities, so they make terrible decisions driven by fear. The wealthy, on the other hand, have spent years learning how money works. They understand business fundamentals. They know how to read financial statements. They can calculate whether something is overpriced or underpriced. When a recession hits, their knowledge becomes a superpower. They can look at a beaten down stock and say, This company still has strong cash flow, low debt, and a great product. It's down 70% because of panic, not fundamentals. That's a buy. Fifth principle, the patience paradox. This one goes against everything we're taught about success. We live in a culture of now, immediate gratification, quick wins, get rich quick schemes. Everyone wants results yesterday, but here's the paradox. The fastest way to build real wealth is to be willing to wait. Wealthy people don't need money right now. They have enough to live comfortably, so they can make investment decisions based on 5, 10, 20-year horizons. They can buy something undervalued during a recession and just hold it. Let it recover. Let it grow. No pressure to sell quickly. Most people can't do this. They need results now. They need that investment to pay off soon because they have bills to pay, debt to service, limited runway. So even when they manage to buy something at a good price during a recession, they often sell too early. They get scared when it drops more, or they need the cash. They don't have the luxury of patience. The patience paradox says that wealth allows patience, and patience creates more wealth. It's a cycle that perpetuates itself. Let me break down why this is so powerful during recessions specifically. When you buy assets during a recession, they often get worse before they get better. Stocks might drop another 20%. Real estate might take a year to bottom out. People without patience panic and sell during these drops. They think they made a mistake. But wealthy investors understand that recessions don't last forever. The economy is cyclical. What goes down will eventually come back up. They can emotionally and financially afford to ride out the temporary pain. Even better, when things drop further, they buy more. They average down their cost basis. They accumulate assets at even better prices. Then comes the recovery, and this is where the magic happens. Those assets they bought at recession prices don't just recover to previous levels. They often go on to reach new highs, and the wealthy investors who held through the darkness capture all of that upside. Meanwhile, the impatient investors who sold during the drops are on the sidelines watching, wishing they had held on. Here's what most people don't realize about wealthy people in recessions. It's not actually about the money at all. Yes, having cash helps, having assets helps, having multiple income streams helps, but the real difference is psychological. Wealthy people have trained themselves to see volatility as opportunity instead of threat. They've programmed their brains to run toward fear instead of away from it. And here's the thing, this isn't a personality trait you're born with. It's a skill you can develop. Think about the first time you drove on the highway. Terrifying, right? Cars going fast all around you. One mistake could be catastrophic, but after you did it 100 times, it became normal. Your brain stops seeing it as a threat. Investing through a recession is the same. The first time is terrifying. Everything in your body is screaming at you to stop, to sell, to protect yourself. But if you can push through that fear, something shifts. The second recession is less scary. The third one, you almost look forward to it because you've seen the pattern. Here's the truth. Nobody wants to say out loud, the system is designed to reward people who already have resources. It's not fair. It's not right. But it's reality. Recessions are just when this becomes most obvious. The person with cash, knowledge, multiple income streams, and patience will acquire assets from the person without these things every single time. But here's the good news. You can move from one category to the other. You don't need to be born rich. You don't need a trust fund. You don't need to win the lottery. You need to start building the 5 advantages we just discussed, even in small ways. These things compound over time. Your first recession might just be about surviving. Your second recession might be about staying stable. Your third recession might be about thriving. The next recession is coming. Maybe next year, maybe in 5 years, but it's coming. The question is if you would be ready for it by then.